Welcome to Investing Ramp, where we explore ways to ramp up our investments. In this video, I'm diving deeper into why the common investing phrase, "time on the market beats timing the market," is proven to be true. Stay until the end to find out why it makes a real difference to your investing success. I'll use a well-known dividend ETF, SCHD, or Schwab US Dividend Equity ETFs, and show you two concrete examples of why time in the market beats timing the market, including dividend compounding and lower volatility. Example 1. Let's suppose you invested $10,000 in SCHD on January 2, 2014, when the price was $29 per share, and you held the shares until August 23, 2023, when the price was $74 per share, and reinvested all dividends. Now, according to calculations, your initial investment would have grown to $37,600, with an annualized return of staggering 15% per year. You just more than tripled your money in less than 10 years by just staying invested. Second example, now you tried to time the market and bought $10,000 worth of SCHD shares on January 2, 2018, when the price was $52 per share. You sold the shares on December 24, 2018 for $44 as price fell, but you also missed out on future benefits. You missed out on the dividends that SCHD paid in March and June of 2019, and all that followed, as well as the price recovery occurred during the pandemic. Here is a good chart explaining how you could have grown $10,000 into $700,000 by staying invested all days, instead of losing out on the days when market went up. Now you see why time in the market beats timing the market. Thanks for watching. And as always, let the compounding force be with you.